Okay, so now we can talk about liquidity ratios. Remember, I explained that liquidity means the ability of a firm to pay off its short term obligations. All right, so we're looking at the money we have to pay off our suppliers, any accruals, any bank overdraft, and this money obviously has to come from your current assets. So the first ratio that we should use is called the current ratio. Current ratio compares the number of current assets the firm has versus the current liabilities. So, current assets versus current liabilities should give you an indication about how much current assets does the firm has at the moment to pay off its current liabilities. So we can say that current assets are the funds out of which a business should pay off its current liabilities. We would want this ratio to be somewhere around 2:1, and that's an ideal number. Even 1.5 above should be good, but that will account for the fact that for every $1 of current liability we should ideally have $2 of current assets. That should be sufficient enough to pay off your current liability. Okay, so the current ratio is one method to measure liquidity, but there is an essential issue with it. That issue is your inventory. Now, inventory can be called the least liquid item amongst your current asset. What do I mean by that least liquid item? So, let's say if your suppliers show up one morning and they ask for their money back instantly, you can access your bank account, you can call up your trade receivables, ask them to pay them off instantly, but you cannot sell your inventory instantly. All right, so selling of inventory depends a lot on the demand as well. So, I can classify inventory to be the least liquid item. So to adjust for your current ratio and to see how liquid it is, we use something called the acid test ratio or the quick ratio. What acid test ratio will do is it will exclude inventory from your current assets and then compare it to current liabilities. We would ideally want this number to be 1:1. So what this ratio will explain is that for every $1 of current liabilities, what amount of liquid assets do we have to pay off these current liabilities. All right, so for a manufacturing firm, for example, they would look at asset test ratio because a good chunk of the current assets for a manufacturing firm would be inventory. So once I remove inventory, I would want to see how much money does the firm have in its bank account, receivables that can be used to pay off your current liabilities. All right, so current ratio and asset test ratio are quite linked together. Okay, now we can also talk about efficiency in terms of liquidity. Let's take a look at that. Okay, one ratio to look at is called the trade receivable turnover or trade receivable days. So we will measure trade receivables upon credit sales only, because remember, trade receivables are generated from credit sales multiplied by 365. That's the number of days. Now this ratio will shows the number of days taken by the customers for the firm to pay off their outstanding amount or their receivable. So if I sell good, let's say on day 0, how many days will the receivables or my customers take to pay me off? A firm would ideally want that the earlier the receivables can pay, the more money it will be converted into cash and will be more liquid, and the firm can use that to pay off its suppliers and other current liabilities. All right, so I would want this number ideally to be low. All right, so the lower the trade receivable days, it is better for the firm. But also remember this, that we cannot just sell on cash. We do have to sell on credit, which means that we have to allow some time for our customers to pay us off. We can also measure inventory days. Inventory days will measure the number of days taken by the firm to sell off its inventory, which is average inventory upon cost of sales. Now, what is average inventory? I can define average inventory to be opening inventory plus closing inventory divided by 2. Remember, whenever you have to take an average, take the starting value and the ending value divided by 2. So once you have your opening and closing inventory, you guys can find the average. So average inventory divided by cost of sales or cost of goods sold into 365. This should show the number of days taken by the firm to sell off its inventory. Now again, I would want the earlier I can sell my inventory, the more money it will generate in terms of cash. So I would also want this number to be low. Another way to look at inventory days is through the inventory turnover, or you can say rate of inventory turnover. So I'll just flip this up, cost of sales upon average inventory. So this will tell me the number of times in 1 year the firm was able to rotate its inventory. An easier approach to understand is this, that if inventory days was 30, which means that it takes you 30 days to sell off your inventory. So approximately in a year, you were able to turn over or rotate your inventory 12 times, since there are 365 days in a year. So we can say that inventory turnover is also important, just like inventory days, because quicker the firm is able to sell its inventory, the sooner it can realize its cash as well. All right, now let's talk about trade payables as well. Similarly, when we look at trade payable turnover or trade payable days, we will use our trade payables, divide that by credit purchases into 365. This will tell us the average time taken by the firm to pay back its creditors or its suppliers. So, just like under trade receivable days, when we were measuring the time taken by our customers to pay us off, over here we are measuring the time taken by the firm to pay off its suppliers. Now, ideally, I would want this number to be high. Why is that? Because the more time I have to pay off my suppliers, it will not put pressure on the firm's liquidity. But again, we cannot have this number to be extensively high, because your supplier can also end up not selling to you, and he would refuse to give you any other credit term, or let's say discount. So the firm would have to balance this, that is, not extend the credit period for its suppliers, but also maintain sufficient time to pay off the suppliers once the money has been received from trade receivables. So for this, what we also calculate is called an operating capital or working capital cycle. That should look something like this. So we will take inventory days that we've calculated, we will add the trade receivable days and subtract our trade payable days. Now what will that show? So let me illustrate that. So let's say a firm has a 30-day inventory day, which means that it takes the firm 30 days to sell off its inventory. It has a 35-day receivable days, which means that receivables take 35 days to pay us off. And the firm has a 50-day trade payable day. Now, what does that mean? Let's take a look at the timeline. This is day 0, where I have purchased the good. Now, it will take me roughly 30 days over here just to sell the inventory. That's my inventory days. All right. And after that, your trade receivables will take 35 more days, which means that once I add 35 days, they will pay me on the 65th day. However, you have to pay back your suppliers on the 50th day. So if you'll receive money on the 65th day, but you have to pay off your supplier on the 50th day, there is a 15-day working capital shortage. That's the money that firms usually borrow from the bank. So firms have a running finance or a working capital line, which is this gap they will borrow, and the bank will charge them an interest, because on the 50th day they will pay off the supplier, but they will pay back the bank on the 65th day. This is called the operating capital, operating cycle, or the working capital cycle. So, if you guys see a question on the exam, do also refer to the working capital cycle to understand the liquidity position of the firm. All right. So, that's it for liquidity, but we should also go through some of the limitations of ratios. So, let me also show the limitations. Okay, few points to remember. Number one, ratios will only be reliable if the numbers are accurate. So if there's any distortion in your number, ratios will not be reliable. Okay, besides that, information must be timely over here. All right, so let's say that some information comes with a lag, so that can cause some issue in analyzing or interpreting your ratios. Okay, ratios do not explain the cause of the change but may indicate the area of concern. So let's say you guys will understand that gross profit margin has increased or decreased, operating profit margin has increased or decreased, your current ratio has decreased, but this will have to be analyzed as what did cause the change. So again, one needs to have an understanding of the reasons why there was a cause of any change. For example, you can say that once coal prices go up, what happens is usually the raw material prices for certain firms which use coal in their manufacturing process will go up. So now you would need to know this information, that coal prices have increased the cost of sales, which is why your gross profit margin has decreased. And we can also say that ratios do not recognize seasonal factors when profit margins will be lower. For example, for a hotel chain in the winter season, let's say sales would be less. Now ratios cannot analyze that why was our profit margin lower than any other factor. One thing to add, let's say if a situation comes where, let's say, there's a hit on the economy, and because of that the numbers are not in line with the previous results, then again one would need to have that understanding. All right, so that's it for liquidity ratios, and we've also looked at profitability ratios. Now, from the next video, I will start solving questions on ratios.